Okay, so think about this. Have you ever swiped a credit card? Or maybe use something like Klarna or Afterpay for installments, even a housing fund loan.
Huh.
Well, the money behind those everyday actions, and even bigger things like highways and bridges, it's often connected to this thing called asset securitization.
It really is. It's a pretty powerful financial idea that's genuinely reshaped global finance. And yes, it's woven right into your daily life, often in ways you might not even notice.
Right. So for this deep dive, our mission really is to unpack asset securitization. I
Yeah.
want to figure out what it is, see where it crops up around you,
hmm
connect it to those really big historical moments
hmm
like the U.S. subprime crisis,
Definitely.
and then, bring it right up to today. Look at how it relates to potential risks in China, particularly maybe beyond just the real estate market people talk about.
Yeah.
We'll guide you through it, try and pull out the key insights.
Yeah, the goal is to make something that sounds, frankly, a bit intimidating, feel clear, and hopefully quite interesting.
Okay, let's dive in then. The core idea, I read, is something like, give me a cash flow and I will securitize it. What does that actually mean, though?
Okay, think of it like this. You have an asset, right? And this asset is expected to generate cash payments in the future. That's your cash flow.
Okay.
Asset securitization is the process of taking those expected future payments, bundling them together with lots of others,
Mm.
using some financial engineering to turn that bundle into securities, like bonds, essentially, and then selling those securities to investors.
Okay, maybe an example. Something familiar, like Ant Huabei or JD Baijiao. How do they get the cash to keep lending out?
Right, good example. Asset securitization is absolutely a major source for them. So when you use Wabe for, say, buying something in installments, you're making a promise, right? A promise to pay back the principal plus interest over time.
Yeah, those monthly payments.
Exactly. Now, multiply your promise by, I don't know, millions of other users doing the same thing, and suddenly has this huge and quite predictable stream of future payments coming in. That's the cash flow asset.
Ah, I see. All those expected repayment.
Precisely. So Ant takes these future loan repayments, these assets, bundles loads of them together, and packages them up into what are called asset-backed bonds, or ABS.
Go.
Then they sell these bonds on the financial markets. Who buys them? Well, investors like commercial banks, securities firms, bond funds, that sort of institution.
And these investors, they're basically buying the right to receive my future payments and everyone else's.
In essence, yes. They buy the bonds because they offer a relatively stable return, maybe somewhere around, say, 4% or 5%.
Okay.
Now, the platform, like Ant, they benefit hugely because the interest rate you pay on your Huawei loan might be, let's say, around 15%.
Right.
So Ant gets to pocket the difference. That's roughly a 10% gap, the interest rate spread. They make that spread on the money you borrowed, while the investors who bought the bonds get their 4 or 5% return from your payments flowing through.
So the spread is the profit, and selling the bonds gives them fresh cash to lend out again.
Exactly right. Selling those bonds raises capital, often very quickly. And that fresh cash, they can immediately use it to lend out to more users. It creates this cycle, you see. Lend money, generate future payment promises, bundle and securitize those promises, sell the bonds to get cash back, then lend out more money.
Wow.
The scale can be enormous. I mean, the figures mentioned suggest Ant Huabei issued something like 160 billion yuan worth of these securitized products just between 2016 and 2017.
160 billion.
Yeah. And if they're making, say, a 10% spread on that volume, well, the potential profit is huge, around 16 billion yuan in that period.
That really puts the scale into perspective. And this model, packaging up consumer loans, whether it's credit card debt or these digital installment things, is this common globally?
Oh, absolutely. It's a very widely used model. They call it credit card loan asset securitization. You see it with giants like American Express, banks like Citibank, Bank of America in the U.S. And in China, too, big players like Bank of Communications, China CITIC Bank, they do this with their own credit card portfolios.
Okay, so fundamentally, it's about taking these streams of expected future income and turning them into something solid, something you can sell today to get cash. It sounds, well, relatively straightforward when you put it like that. So why is it seen as, like, one of the biggest financial innovations of the last 50 years?
That's a great question. To really grasp why it was such a game changer, we need to step back a bit, look at the U.S. after World War II.
Right.
Back then, the U.S. government was really pushing home ownership, big time. And this led to a massive boom in real estate mortgage lending, especially through the 1960s.
Right, and the banks were just holding these mortgages for like 20 or 30 years.
Exactly. Imagine banks sitting on piles and piles of these long-term loans. It tied up vast amounts of their capital. These were essentially illiquid assets, money locked away, not doing much for the bank for decades. They couldn't easily use that money to make new loans.
So they needed a way to free up that cash. And securitization was the answer.
It was the perfect solution, really. Investment bankers figured out, hey, we can take these future mortgage payments, package them together into bonds, and sell those bonds to investors. These were the very first types, often called pass-through bonds, where the payments from homeowners literally pass through to the bond investors.
So it was like taking this stagnant pool of locked-up loans and turning it into a flowing river of cash for the banks.
That's an excellent analogy. It totally solved the bank's liquidity problem almost overnight. By selling these mortgage bonds, banks got cash back immediately. What do? They lent out even more money for mortgages.
Right.
This poured fuel on the U.S. real estate market for decades. Just look at the Case-Shiller Home Price Index. It apparently soared from about 25 in the 1970s to 180 by 2007. Those illiquid mortgage loans sitting quietly on bank balance sheets were transformed into liquid asset-backed securities, traded freely in the financial markets.
And the impact wasn't just about mortgages, was it? It seems like it connected different parts of the financial world that were separate before.
It absolutely did. You have to remember, before this really took off, commercial banking, taking deposits, making loans, indirect finance and investment banking, helping companies issue stocks and bonds, direct finance, they were kept pretty separate in the U.S., especially after the regulations following the Great Depression, like the Glass-Steagall Act in '34.
Okay.
Asset securitization built this incredibly powerful bridge between those two worlds. It opened up huge avenues for financial innovation. We're talking sophisticated quantitative trading models, complex financial engineering, especially from the 90s onwards. And it fueled the massive growth of what people call the shadow banking system, basically.
Right.
Bank-like financial activities happening outside the traditional, heavily regulated banking sector.
So it was like building this massive new pipeline system connecting everything.
You could definitely see it that way. It connected the real economy, people buying houses, using credit cards, directly to the capital markets where investors were looking for returns. This injected enormous liquidity into the whole system and was a huge factor in the financialization of the economy. It's widely seen as a major driver of what they call financial deepening since the 1980s.
Incredible how one technique could ripple out like that. And we see asset securitization closer to home, too, in other everyday things.
We do. Think about real estate investment trusts or REITs.
Ah, yes, REITs. I've heard of those. How do they fit into this?
Well, REITs essentially take the income generated by a collection of properties, say the rent from an office building or a shopping mall or apartment complexes, and they package that stream of rental income as an asset.
Okay.
This income-generating asset is then put into a fund, and that fund is divided up into lots of small shares, just like shares of stock in a company.
So if you can't afford to buy a whole shopping mall yourself, you can buy shares in a REIT that owns malls, and you get a slice of the rental income. And maybe benefit if the property values go up.
That's precisely the idea. The value of your REIT shares is tied directly to the income and the value of the underlying properties. It's a way for ordinary investors, maybe younger people without huge savings, to get exposure to real estate income and potential appreciation without needing to buy, manage, or sell a physical building.
Are they popular?
Extremely popular, especially in the U.S. The material mentions that over 20% of the U.S. population invests in them. That's like 70 million people. And historically, they've apparently done quite well over the last 30 years, often outperforming inflation, stock market indices, and regular bonds.
What's the situation in China with REITs?
China has had private REITs for a while, and there's been a lot of talk and development towards launching publicly traded REITs. The goal is similar, to allow more people to participate in the economic benefits coming from things like urbanization and infrastructure development through investing.
In infrastructure, you mentioned highways earlier. How does a road get securitized?
Yeah, lots of big infrastructure projects use this. Think about a toll road. The company building it anticipates collecting tolls for years, right? That future stream of toll revenue can be packaged up into bonds and sold to investors now to raise the money needed to actually build the road.
Ah, okay.
The Guangshan Highway was mentioned as an example where future tolls were securitized. And many government-promoted PPP projects, public-private partnerships, also rely heavily on this kind of financing.
So whether it's loan repayments or rent from buildings or tolls from a highway, the key thing that allows something to be securitized is that it has to have what?
Stable, secure, and crucially predictable cash flows. That is the absolute number one condition. The more predictable and reliable that future income stream is, the easier it is to securitize. And honestly, that's why, despite all the creativity, housing mortgages are still the biggest single category in the global asset securitization market. Their payment streams are generally quite stable over long periods.
Makes sense. If that underlying cash flow is unreliable, the whole structure built on top is shaky. Which I guess brings us neatly to the dark side. We have to talk about how asset securitization is linked to the 2007 U.S. subprime crisis.
Yeah, it's
Well,
it's a critical piece of that story, but it's really important to be clear here. The crisis wasn't caused by the tool of asset securitization itself. Like any powerful tool, a hammer can build a house or can break a window. It's neutral. The problem was how it was used.
okay, so according to the analysis, what really went wrong? What were the main causes of the subprime meltdown?
The sources really highlight two fundamental issues. First, the incredibly poor quality of the underlying assets being securitized, and second, the excessive layering and complexity, basically, over-applying the technique.
Okay, let's unpack the first one.
Mhm.
The assets themselves were bad. The garbage cannot become gold idea.
Right. So, context. After the dot-com bubble burst around 2000 and then 9/11 happened, the U.S. economy was under pressure. The government was looking for ways to stimulate growth, and a big part of that was encouraging more home ownership, pushing the American dream.
Mm-hmm.
So you had policies like the Federal Reserve slashing interest rates. They cut them 13 times from 6.5% down to just 1% between 2001 and 2003. You also had things like the American Dream Down Payment Act and government mandates pushing institutions like Fannie Mae and Freddie Mac to buy more mortgages made to lower income households.
And all this pressure meant banks started lending to riskier borrowers,
Mhm.
people who maybe couldn't really afford the loans.
Precisely. Banks dramatically lowered their lending standards. I mean, back in the 90s, you typically needed a decent down payment, maybe 20% in proof of income. By the mid-2000s, it went down to 3% down, then zero down payment loans became common, and you had stated income loans, basically. You just told them your income, no real verification needed. The anecdote about getting calls offering these zero down loans, even as a student, really says it all.
Wow, yeah, that's incredibly loose.
It really was. And you saw a huge shift in who was getting mortgages. In the 90s, it was mostly solid middle-class families. By 2006, something like 76% of the mortgages being bought by Fannie and Freddie were for low-income, middle-income, or poor families. These high-risk, often poorly underwritten mortgages became known as subprime loans. And by 2007, these subprime loans made up apparently half of the entire U.S. mortgage securitization market.
Half the market. So at that point, you couldn't just pretend the quality issue wasn't there.
Not on that scale, no. Think of the rotten apple analogy. Maybe you can hide one or two bad apples in a huge barrel, but if half the barrel is rotten, no amount of fancy packaging is going to fix the underlying problem. It's like trying to blend rotten apples into a smoothie and sell it as premium. The rottenness is still fundamentally there.
Okay, and that rottenness then gets amplified by the second cause. The excessive, layered packaging.
Yeah.
The toxic asset infiltrate idea.
Exactly. This is where Wall Street's financial engineering really went into overdrive. Once they got good at securitizing basic mortgages, they realized, hey, we can take these mortgage-backed securities we just created and securitize them again, especially after the 90s with all the advances in derivatives, pricing models, and quantitative finance.
Why? Why would they layer securities on top of securities? What was the point?
Primarily to increase leverage and chase higher returns. They created these incredibly complex structures, slicing and dicing the original mortgage pools many times over, building layers upon layers of new securities derived from the older ones.
It sounds like those Russian nesting dolls, where the original subprime loans are hidden way down deep inside multiple layers of packaging.
That's a perfect analogy, layer after layer after layer. And this complex packaging had the effect of, well, beautifying the assets on paper. It made them look safer than they were. The sheer complexity made it almost impossible for regular investors and, critically, even the big credit rating agencies like S&P and Moody's to accurately assess the true risk buried inside.
But they still got good ratings.
Often, yes, they received high credit ratings, like AAA. The sources suggest this reflected a mix of things. Maybe some arrogance, perhaps misplaced faith in the math models, definitely greed, and just the desire for the high fees these complex products generated. These layered products, often called CDOs, collateralized debt obligations, containing those toxic subprime loans at the core, were then sold and traded throughout the global financial system. like a game of hot potato with a ticking time bomb.
And by 2007, these toxic assets were just everywhere.
Pretty much. They had seeped into almost every corner of the financial system. By 2007, banks, investment firms, insurance companies, pension funds, you name it, they all held significant amounts of these subprime-linked securities or the derivatives based on them. Lehman Brothers is the famous example. Their leverage reportedly hit 32 times their capital. AIG was insuring huge amounts of this stuff. It was systemic. The cancer cells of subprime debt had metastasized throughout the financial body via these complex, layered, securitized products.
So what finally set off the collapse? What was the trigger?
It was really a combination of two things hitting at once. First, U.S. interest rates started to climb in 2006. This made those adjustable rate mortgage payments much more expensive for the subprime borrowers who could barely afford them in the first place.
Right.
Second, and critically, U.S. housing prices, which had been booming, started to decline in the summer of 2006. Suddenly, homeowners couldn't just refinance their way out of trouble, and they were finding their homes were worth less than their loans. The underlying weakness of those subprime loans was brutally exposed. People couldn't pay.
And then the defaults just started piling up.
Exactly. Defaults surged. As soon as that happened, the complex securities and derivatives built on those mortgages became effectively worthless and completely illiquid. Nobody wanted to buy them.
Chaos.
Complete chaos. Over 400 subprime lending companies collapsed. The rating agencies, realizing their mistakes, started frantically downgrading bonds they'd previously rated AAA, sometimes down to jump status overnight. Panic selling erupted. Major institutions holding this toxic waste faced catastrophic losses. Bear Stearns collapsed and was sold off cheap. Lehman Brothers went bankrupt. Merrill Lynch had to be rescued through acquisition. Even giants like Goldman Sachs and Morgan Stanley had to fundamentally change their structure to survive. The subprime crisis had fully detonated, and it became a global financial catastrophe.
Wow. A stark reminder of the downside. After that whole experience, surely there was a lot of reflection on asset securitization and how to manage it better.
Oh, absolutely. A huge amount of reflection. And the key takeaway, again, was that asset securitization itself isn't inherently evil. It's a neutral, powerful financial tool. The damage came from how it was used, or rather, misused.
So what are the big lessons, the core principles for controlling the risks that came out of that?
Two really stand out. The first, and by far the most critical, is you must strictly control the quality of the underlying assets. The assets going into the securitization pool have to be sound. Securitization repackages risk, it redistributes risk, but it doesn't eliminate risk. The analogy used is like photo editing. You can make someone look very different in a photo, but it doesn't change the actual person. You simply cannot turn garbage into gold just by wrapping it nicely. The foundation has to be solid.
Right. Quality first. Makes sense. What's the second principle?
The second is to strictly regulate and control excessive resecuritization and the leverage built upon it. That endless layering, building derivatives on derivatives combined with very high leverage, it just amplifies risk to an incredible degree. It allows even small problems at the base layer to cascade rapidly and threaten the entire system. Keep the chains shorter and the leverage reasonable.
Okay, those seem like clear guardrails. Let's try and apply them now. Thinking about China today, especially with all the focus on the property market, a lot of people ask, does China face a similar risk of a subprime crisis, specifically in its real estate mortgage sector?
Right, it's a common question. If we use those two principles underlying asset quality and the degree of resecuritization, we can analyze the situation based on the information we have.
Okay, let's start with asset quality. What about down payments for mortgages in China, historically?
Well, historically, China has been known for having very strict down payment requirements compared to many other countries. For a long time, 30% was common for a first home. And for second homes or in major cities during boom times, it could be 40%, 50%, even 60% or higher.
That's definitely a big difference from the zero-down situation in the U.S. pre-crisis. But haven't there been some changes recently? Policies adjusting?
Yes, there have been adjustments, particularly starting around September 2024. The People's Bank of China lowered the national minimum down payment for second home commercial mortgages, bringing it down from 25% to 15%, aligning it with the minimum for first homes. And following that, many individual cities adjusted their local minimums too. For instance, Beijing announced that from October 1st, 2024, the minimum for first home commercial loans would be 15%, and for second homes, 20%. Shenzhen made similar changes around the same time. Other cities have also adjusted, often differentiating between commercial loans and provident fund loans and first versus second homes, but generally moving towards lower minimums than the historical peaks.
So minimums are coming down, but starting from a much higher base than the U.S. had, and generally still requiring some significant equity from the borrower, at least based on these examples.
Generally, yes, that seems to be the case based on these examples. Even at 15% or 20%, it's still quite different from zero down.
Okay. What about the second principle, excessive resecuritization? How much complex layering happens with Chinese mortgages?
On that front, China has maintained very strict restrictions. The kind of highly complex mortgage derivative market that exploded in the U.S., things like CDOs, CDOs squared, synthetic CDOs built on mortgages, that infrastructure just hasn't really developed in China's mortgage market. Resecuritization is tightly controlled.
Okay, so putting those two pieces together, historically higher down payments, though easing, and strict limits on complex resecuritization. What's the conclusion on the risk of a U.S.-style subprime crisis in China's mortgage sector?
Based purely on the analysis of those factors presented, the risk of a widespread subprime crisis originating specifically from China's real estate mortgage sector seems extremely low, at least based on the situation described up to early 2025.
Got it. Extremely low for mortgages.
Yeah.
But that doesn't mean China is totally free from subprime-like risks, right? The sources suggest the real concern might lie elsewhere, but still connected to securitization.
That's correct. While the mortgage sector seems relatively contained for now, there is another area where China has faced potential subprime level risks, and yes, asset securitization plays a role there too. That area is cash loans.
Cash loans.
Yeah,
You mean those unsolicited calls or app notifications? Need cash fast, quick approval, no collateral.
exactly those. They're essentially pure credit loans, usually for short-term personal consumption, where the lender often has very little idea what the borrower will actually use the money for. Think about some of the horror stories you might have read online: nude loans, predatory student loans, compounding interest traps. Many of those fall into this cash loan category.
Right. What makes them particularly high risk compared to, say, a mortgage or even a credit card?
Several things. First, they're typically very short-term, maybe just a few months. Second, they come with extremely high interest rates, often exceeding the legal limits, with annualized rates well above 36%, sometimes even over 100%. Third, the loan amounts are usually small, maybe under 10,000 yuan.
And the risk comes because the lender doesn't know where the money's going.
That's a big part of it. Unlike a car loan where the money buys the car or a mortgage for a house, this cash can go anywhere, paying bills, buying luxuries, gambling, maybe even speculating in the stock market. It's very hard for the lender to control the risk. Plus, it's difficult for one lender to know how much an individual has already borrowed from other cash loan platforms.
Which leads to people borrowing from multiple places at once, that rolling over debts problem.
Precisely. Taking out a new loan just to pay off the old one. This market segment absolutely exploded in China, particularly starting around 2016. After many P2P lending platforms faced crackdowns and failures, they pivoted, and a lot of them jumped into the cash loan business from the second half of 2016. The scale just ballooned. Reports mention at least 30 major P2P platforms getting involved.
And the appeal, especially to younger people, is the simplicity and speed. Download an app, get cash fast.
Yes, that's the hook. It seems incredibly easy. Minimal information required, instant approval, money in your account. And the interest rate is often presented deceptively like a small daily fee. Borrow 5,000 yuan, only pay 10 yuan a day in interest. It sounds affordable day to day.
But when you annualize that,
It's shocking. Let's do the math. 10 yuan a day for 90 days, 3 months, is 900 yuan in interest. So you repay 5,900 yuan on a 5,000 yuan loan. That's an 18% return for the lender in just 3 months, annualized. That's roughly 72%. That's deep into usury territory.
72%, wow.
And who do these often target? Often it's younger people, maybe with lower incomes, but high consumption desires the latest phone, online games, cosmetics, maybe even cosmetic surgery. The easy access encourages repeated borrowing. Data suggests typical active users borrow multiple times, like an average of 6 times in 6 months. And over 30% borrow from 3 or more different platforms simultaneously. This isn't just emergency borrowing, it becomes a regular habit, often just to juggle existing debts.
And all this borrowing and debt rolling just builds up the risk across the system.
Absolutely. Each new loan adds leverage, layer upon layer of debt. risk accumulates rapidly. If one major platform fails or if a large group of borrowers defaults, it could easily trigger a cascade of failures across the whole cash loan ecosystem.
That sounds very much like the definition of poor quality, high-risk lending, essentially subprime lending, but for consumer cash.
That's exactly what it is. These cash loans represent high-risk, poor-quality assets. It's effectively subprime lending within the consumer credit market.
Okay, so here's the worrying connection. Are these risky cash loans also being securitized, turned into bonds and sold off?
Unfortunately, yes, a significant portion of them are.
How does that even work? Especially if many of these platforms aren't licensed banks.
Well, most of these online cash loan platforms, apart from the properly licensed banks or consumer finance companies, operate in a gray area and have limited capital themselves. So how do they get more money to lend out? A primary method is asset securitization. They take thousands of these small, high-interest loans, bundle them together, package them, maybe try to beautify them with financial structuring, and sell them off as securitized products.
And who buys these securitized bundles of risky cash loans?
They're typically sold to other financial institutions, maybe smaller banks that are chasing higher yields, some funds, trust companies, securities firms.
And potentially these end up in products sold to the general public, like wealth management products.
That's the concern. These securitized cash loans can become the underlying assets hidden within various wealth management products that ordinary investors like you might buy, perhaps attracted by a higher than average interest rate.
So if I see some online wealth management products offering, say, a 10% return, it could have these risky loans buried inside.
It's definitely possible. Think about it. If a product is promising you 10%, the underlying loans or projects need to generate significantly more than that, maybe 15% or even higher, to cover the platform's costs, the distribution costs, and profits for everyone in the chain.
Right.
So you have to ask yourself, are there really that many safe investment opportunities out there yielding over 15% that traditional banks haven't already snapped up?
Probably not very many, no.
Exactly. It comes back to that fundamental principle. Risk and return are linked. If something offers a suspiciously high return, especially in the online finance space, you absolutely need to question what the underlying assets are and how risky they might be. Be very cautious.
It sounds like the regulators in China saw this risk building up with cash loans and securitization.
They did. Recognizing the explosive growth and the potential for these toxic assets to spread through securitization, Chinese regulators took decisive action, notably starting in December 2017 with things like the Notice on Rectifying and Regulating the Cash Loan Business. These regulations aim to slam the brakes on the riskiest parts of the market by restricting who could offer cash loans, requiring licenses, capping the interest rates that could be charged, and limiting the funding sources for these platforms, including restricting how much could be funded via securitization.
And the goal was basically to prevent a kind of mini subprime crisis blowing up in this specific sector.
That seems to have been exactly the goal, to contain the risks before the market became uncontrollably large and these toxic securitized cash loans spread too widely throughout the entire financial system. More recently, actions like the late March 2025 ban on excessively low consumer loan rates, below 3%, also fit into this picture, aiming to curb regulatory arbitrage and ensure banks aren't taking on undue risk by lending below their own funding costs, which could also destabilize the system.
This has been quite the journey, starting from just swiping a card and ending up deep in global finance and risk management.
It really shows how interconnected everything is. Asset securitization is fundamentally this incredibly powerful and, in itself, neutral financial technology. It connects different pools of capital, it provides liquidity, and it's present in so many parts of modern finance and our daily lives.
But like we saw, that power is a double-edged sword. If the underlying assets are bad, the garbage, or if the technique is applied recklessly with too much complexity, too many layers, too much leverage, it can unleash immense damage. The U.S. subprime crisis is the ultimate cautionary tale there.
Precisely. And while China's mortgage market, due to its historically stricter underwriting and limits on complexity, seems to have avoided that specific type of crisis risk so far, although we need to watch how the easing of down payments plays out, the country did face a significant potential subprime-style risk in that rapid, largely unregulated boom and subsequent securitization of high-risk cash loans. Thankfully, regulators stepped in to address that specific danger.
Okay, so let's leave our listeners with a final thought. Asset securitization, we've learned, hinges on taking predictable future cash flows and turning them into assets that can be traded today. So think about your own life, the things around you. Your salary, maybe, subscription payments you make, even the projected income of a local business. Can you start spotting where this fundamental idea, turning future income into present value, might be at work? Perhaps invisibly, through securitization.
And perhaps more importantly, the next time you look at a financial product, especially one promising unusually high returns, dig a little deeper. Ask yourself, what is the real, unvarnished quality of the underlying cash flow that's ultimately backing this product, buried somewhere deep inside all the packaging?
We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.